Spring has most definitely sprung in Arkansas, and that could mean a bounce in the stock market. We're also watching a potential hop in inflation. That's the subject of today's Fastest Four. Well, thanks for joining us here on the all-new Fastest Four. I'm Scott Inman. If you've never seen this segment before, well, here's a quick history. We've been recording this quick market update for years as part of the Get Ready for the Future show. It was necessary to fit the different radio formats of our radio affiliates. Well, that's changed and is no longer needed on our radio program, but we didn't want to just stop doing the segment. We know lots of you love it. So here we are, a new set and a fresh take on the Fastest Four. Moving forward, we're going to make this available right in your email inbox. And we're not just talking investments every week. We'll try to keep our finger on the pulse of current events that could impact your finances. We'll talk about retirement-related topics and other timely information that you can apply to your own personal economy. But we will still focus on the market too, and that's where we are spending our time today. We are entering the second quarter of 2021, and April usually means good things for the stock market. Check out this graph from LPL Research. These are the average returns of the S&P 500 broken down per month over the past 70 years. And look at April. We'll just call that a spring bounce. No matter the time measurement, the past 70 years, look at the past 20 years or the past 10 years, or even just selecting post-election returns, they have been positive. The only other month that's competitive there or is better is really November. Of course, these are historical returns and can't be counted on, but LPL Research and many other analysts still believe the new bull market, which by the way just turned one, is just beginning. So what could throw a wrench in things? If you poll the big investors and ask them what are they most concerned about, many of them would likely say inflation. There is a growing concern out there that we may experience out of control inflation. And it's easy to understand the concern with an expanding economy and a huge inflow of money from the historic $3 trillion stimulus package powering consumer spending, plus the position of the Federal Reserve now potentially allowing inflation to run a little hotter. And there's the U.S. Treasury yields. They have been rising. But how concerned should we be? LPL Research tells us they believe the inflation rate may indeed be higher in 2021 than in years past. But remember now, we've been at below average levels. LPL now targeting a cap for core inflation at 3% this year. That would be right around the all-time U.S. average from 1914 all the way to present. Definitely not runaway inflation. So why do they believe it'll be lower? Well, first of all, they say the global economy is not heating up like here in the U.S. Europe, Japan, and other countries have not made the same progress on COVID-19 vaccinations as we have here and are experiencing slower growth than the U.S. And we need global growth for inflationary pressure to truly build. Also here at home, there are parts of the economy that have still not recovered and are not overheating. Case in point, the service industry was hit badly by the pandemic and is still not all the way back. The costs of these services are not going up. That's a big part of overall inflation. Until that goes up, inflation should be held in check. And finally, the unemployment rate is still at 6.3%. That's important because a decreasing unemployment rate can put pressure on wage growth. We want the unemployment rate to go down, but it's got a long way to go before wage pressure mounts. Bottom line, we expect there to be a higher inflation rate this year than in years past, but it should not be out of control. And some inflation is a good thing. That's it for the Fastest Four. Hope you'll check us out again next week.